62% of Americans are living paycheck to paycheck, and it's not just an American problem. In the UK, 40% of adults have less than £100 in savings. This highlights a critical issue. Financial education is lacking. Despite the clear need for it, basic money management skills just aren't taught in most schools. Have you ever wondered why schools never teach you about money? It's a question that confuses most of us, especially when we step out into the real world and realise how crucial financial literacy is. School taught me about the periodic table, but not the basics of retirement. Make it make sense. As Robert Kiyosaki, author of Rich Dad Poor Dad, famously said, financial freedom is available to those who learn about it and work for it. Understanding money management is fundamental to achieving your goals. To help you get ahead, I made a list of 5 essential personal finance tips they do not teach you in school ever. Before we start, don't forget to hit that subscribe button so you never miss a video. Tip number 1, understanding credit scores. Credit scores are vital but often misunderstood. Many young people max out their first credit cards and fall into debt. Your credit score impacts your ability to get a home, get a car loan and secure business funding. Credit rating actually has nothing to do with your salary. Meet Laura and Alex, both earning £40,000 a year, but their credit scores are worlds apart. Laura has a score of 780 whilst Alex struggles with a score of 620. So how did it happen? Laura always pays her bills on time, uses only 20% of her credit limit, has a long credit history, applies for new credit sparingly, maintains a mix of credit types, whereas Alex, he misses his payments, he maxes out his credit cards, he closes old accounts frequently, applies for credit often, he only has credit cards and a personal loan. It's important to start building your credit early, pay your bills on time, pay off debts on time, and maintain a good credit history to avoid financial pitfalls later on. Avoid opening too many new accounts. Every time you do, you apply for credit and it can actually temporarily lower your score. And on the point of accounts, the length of your credit history matters, so keep older accounts open to show a long history of responsible credit use. You should also diversify your credit mix. Have a mixture of credit types such as credit cards, car loans and mortgages. It can really have a positive impact. Number 2, budgeting basics. Budgeting is crucial, but it's never taught. Without budgeting skills, managing bills and distinguishing between needs and wants becomes so challenging. The 50-30-20 rule is such a game changer. First, divide up your income. Divide it into 3 categories: needs, wants, and savings. 50% allocate towards your needs, so expenses like rent, your food, transportation. 30% for wants, so that's non-essential spending such as dining out, entertainment, hobbies, bars, chocolate, whatever makes you happy. And finally, 20% for savings. Dedicate the rest to savings, debt repayment, as well as investing. You can use digital banking tools to make your life that much easier. Most banks will offer features that allow you to create and manage multiple sub-accounts. So you can set up 3 separate sub-accounts for needs, wants and savings. I currently do this in Monzo. You then need to automate the transfer of funds into each sub-account as soon as you receive your income. This ensures that your money is allocated according to your budget without any manual effort. Make sure you're reviewing your budget monthly. If you find you're overspending in one category, adjust for allocations accordingly. Number 3, insurance. Life insurance is the ultimate safety net for when the unexpected happens. It's like having a financial guardian angel ensuring your loved ones are protected even when you're not around. But nobody wants to think about their mortality. All you need to know is term policies make more sense than the whole life insurance. Think of it like this. Would you buy a lifetime supply of avocados when you only need them for your avocado toast phase? Probably not. So why are you committing to a lifetime policy when a term one does the job just fine? Now onto your assets, your car, your home, your health. They are your treasures, so protect them like you would your prized possessions. Consider umbrella insurance for broader coverage. This is extra protection when your other policies reach their limits. It covers so many factors such as bodily injury, property damage and even legal fees, giving you peace of mind in case of unexpected accidents or lawsuits. Remember, when it comes to insurance, shop around like you would for the perfect pair of shoes, so compare rates, coverage and perks before sealing the deal. Number 4, the magic of compound interest. The power of compound interest is one of the best kept secrets. Young people have the advantage of time, which is crucial for compounding wealth. I personally wish I'd started when I got my first job at 16. I could have literally had hundreds of thousands in the bank. Even small amounts saved in high interest accounts can grow substantially over time. Look for high interest savings accounts or cash ISAs that offer competitive interest rates. Say you put £10,000 in a cash ISA with an annual interest rate of 7%. Grow over a period of 35 years to approximately over £75,000 without you investing a penny more. Literally the magic of compounding. Why were we not taught this earlier? Number 5, building an emergency fund. Shockingly, 44% of UK adults don't have £500 saved for emergencies. It's time to take control because you just don't know when an emergency fund is needed. I'm talking your roof caving in, car repairs, sudden job loss, not your emergency nail appointment. Strive for a safety net of 3 to 6 months' expenses. You want to learn how much you should save based off your personal situation. Some unique ways to save for emergency fund which you don't see on any other videos. Make sure you watch this video right here. Thank you so much for watching. Make sure to subscribe to Unfudge Your Finances and I'll see you in the next video.